The Federal Reserve, often referred to as the Fed, uses interest rates as a primary tool to conduct monetary policy, aiming to achieve dual objectives: maximizing employment and stabilizing prices. Changes in the federal funds rate, which is the rate at which banks lend to each other overnight, can have widespread effects across the economy. Impact on the economy: consumer spending. Higher interest rates typically lead to decreased consumer spending. As borrowing costs rise, loans for homes, cars, and consumer credit become more expensive, reducing the overall disposable income of consumers and their willingness to spend. Investments. For businesses, the cost of borrowing to fund investments or expansion increases with higher interest rates. This can lead to a slowdown in investment spending, particularly in capital-intensive industries. Real estate. The real estate sector is directly affected by interest rate changes due to their impact on mortgage rates. Higher rates make mortgages more expensive, lowering demand for real estate and slowing down the housing market. Stocks sectors more affected. Financial sector generally benefits from higher interest rates due to the wider spread between what banks charge for loans and pay on deposits. Real estate sector typically suffers under higher rates as financing homes becomes more expensive, reducing demand for real estate. Technology and growth stocks, often negatively impacted by higher interest rates. These companies rely on borrowing to fund growth, and their valuations are more sensitive to discount rates used in valuation models. Lags in monetary policy. The effects of interest rate changes don't occur immediately. Monetary policy operates with lags, often taking several months or even longer for the full impact of a rate change to be felt throughout the economy. This delay can make it challenging for the Fed to time its policy moves precisely. Historical perspective. The early 1980s, under Federal Reserve Chairman Paul Volcker, showcased the dramatic impact of Federal Reserve policies on the economy and the stock market. To combat the high inflation of the late 1970s and early 1980s, the Fed implemented a tight monetary policy, significantly raising the federal funds rate, which peaked at around 20%. This aggressive action led to the recession of 1981 to 82, characterized by nearly 11% unemployment and significant strain on the manufacturing, construction, and auto industries. Despite these challenges, Volcker's policies were ultimately successful in reducing inflation from double digits to around 5% by October 1982, laying the groundwork for future economic growth and stability. Economic lags in Fed policy. Monetary policy operates with lags. The effects of changes in interest rates are not immediate. It can take several months or longer for the impact of a rate change to fully permeate the economy. This delay poses challenges for the Fed in timing its interventions to either stimulate the economy or cool down inflationary pressures. The theory behind interest rate policies. Interest rates and monetary policy. Monetary policy involves managing the money supply and interest rates to influence economic activity. The central bank, such as the Federal Reserve in the United States, adjusts interest rates to control economic growth, inflation, and employment levels. The transmission mechanism. The process by which changes in the central bank's interest rates affect the economy's broader conditions is known as the transmission mechanism. It includes various channels like interest rate channel. Lower interest rates reduce the cost of borrowing, encouraging spending and investment by businesses and consumers. Conversely, higher rates discourage borrowing and spending. Exchange rate channel. Changing interest rates can affect the country's exchange rate, influencing exports and imports. Higher rates typically strengthen the currency, making exports more expensive and imports cheaper. Wealth effect. Interest rates can influence asset prices, including stocks and real estate. Changes in asset prices affect consumers' wealth and their spending behavior. Expectations and confidence. The central bank's actions on interest rates can influence expectations about the future economic environment, affecting consumer and business confidence. Inflation targeting. Inflation targeting is a monetary policy. where the central bank sets an explicit target inflation rate and uses interest rate adjustments to achieve that target. The aim is to maintain price stability, which is believed to be conducive to overall economic stability and growth. The Federal Reserve's interest rate decisions are powerful tools that influence various aspects of the economy. The 1980s serve as a stark example of the short-term sacrifices and long-term gains associated with combating high inflation, showcasing the intricate balance the Fed must maintain between stimulating economic growth and controlling inflation. Understanding the Fed's role and the impact of its policies is crucial for comprehending broader economic trends and market dynamics.